Hey everyone, and welcome back to the deep dive. Ever wondered about those massive, really strategic shifts that happen kind of behind the scenes in the business world?
Yeah, the big
The
ones.
mergers that create new giants, the acquisitions that consolidate power, or even, the breakups that totally redefine companies. Well, today we're pulling back the curtain on these truly significant transactions, the ones that shape our economy and, honestly, the companies we interact with every single day.
That's exactly right. Our mission today is to really dive deep into the economic effects of these significant transactions. We want to help you understand not just what they are, but more importantly, why they happen, the kind of intricate mechanisms that make them possible, and what their profound impact truly is. We'll use real-world examples, of course, to make everything, hopefully, clear and relatable.
Yeah, make it stick.
Think of it like a strategic chess game, played at the highest levels of corporate finance. We're here to explain the moves.
Absolutely. Today, we're diving into the fascinating world of business combinations and divestitures. We've gathered a ton of information ready to be sort of distilled into those aha moments for you. We're going to demystify how companies strategically grow together and sometimes how they very deliberately move apart. The economic effect of significant transactions.
Business combinations growing together.
Okay, let's unpack this. When we talk about business combinations, we're essentially discussing how companies expand their operations by, well, joining forces.
hmm
And this isn't just about getting bigger, right? It's about strategic partnerships on a grand scale, aiming for greater market share, maybe enhanced efficiency, or even acquiring totally new capabilities.
hmm
But as you might guess, not all combinations are created equal. There are like four primary types, each with its own unique strategic flavor. It depends on what the merging companies are trying to achieve.
Precisely. The core idea behind any business combination is always about achieving some kind of strategic advantage, whether that's through, say, aggressive growth, achieving greater operational efficiency, or maybe establishing undeniable market dominance. These combinations can take various forms, from outright mergers to more targeted acquisitions or tender offers. We'll break down those specific transaction types a bit later in this deep dive. But first, let's explore the types of combinations themselves. Let's focus on the fundamental strategic relationships that drive them. 1.1. Types of business combinations. 1.1.1 horizontal combination.
Okay, first up, the horizontal combination. So imagine two companies that do pretty much the same thing, right? Same industry, selling similar goods or services, and they decide to join forces under one leadership.
Hmm.
What's the immediate thought that comes to your mind when two direct competitors decide to become one? Less choice.
Well, yeah, that's part of it. What's fascinating here is the immediate and profound impact.
Yeah.
A direct reduction in competition. That can be a huge driver for profitability for the new combined entity. But it's also really about achieving significant economies of scale.
Right. Economies of scale. We hear that term a lot. What does it really mean in this context?
It's not just about producing things more cheaply in general. It's about, say, optimizing entire production lines, maybe gaining immense leverage with suppliers because now you're buying in huge bulk,
Hmm.
or spreading those big fixed costs like think about R&D or large-scale marketing campaigns over a much larger output.
Oh, okay. So the cost per item goes way down.
Exactly, which allows them to either offer more competitive pricing to grab market share or just achieve higher profit margins. By combining operations, they can eliminate redundancy, consolidate their view of the market, and ultimately maximize profits. Streamlining operations, dominating a bigger piece of their shared market, it's a powerful way to consolidate power and efficiency.
Okay, so to illustrate how powerful this can be, remember the merger of Heinz and Kraft Foods back in 2015? They formed the Kraft Heinz Company.
Oh yeah, huge deal.
Right, both were massive players in processed foods, stuff found in pretty much every grocery cart. The expectation wasn't just to become one of the largest food and beverage companies globally, but crucially, they projected something like $1.5 billion in cost savings annually.
Wow.
Yeah, and that's directly attributable to those economies of scale you mentioned, combining supply chains, consolidating manufacturing plants, streamlining all the admin functions. They aim to reduce duplication everywhere, from production to distribution to get that massive synergy.
So if you're a consumer, you might suddenly notice maybe fewer distinct brands on the supermarket aisle over time. The combined company streamlines its product offerings. The immediate promise for the company is, yeah, streamlined operations, more efficient production, and distribution.
But what about the long term? For us, the consumers.
Well, the long-term impact on consumer choice and pricing is a bit more nuanced. With less direct competition, the combined company might face reduce pressure to innovate or offer really aggressive pricing.
Yeah.
That could potentially lead to fewer product variations or maybe gradual price increases over time.
Sounds plausible.
But there's a flip side, too. Their increased scale might also let them make big investments in R&D that smaller competitors just couldn't afford. So that could potentially lead to breakthroughs that benefit consumers down the line. It raises an important question, though. How do we balance these efficiency gains from consolidation with the potential risk of reduced market dynamism?
That's a tricky balance for sure.
Yeah.
1.1.2 vertical combination. Okay, next up, let's move vertically. This is when companies at different stages of a production process come together. They might be from the same industry, maybe even multiple industries,
Yeah.
if their processes are fundamentally linked, right?
Ah,
Creating a sort of chain of control from raw materials all the way to the final product.
exactly. This strategy often assures the supply of raw materials. That's what we call backward integration.
Backward integration. Right.
Yeah, think of a car company maybe acquiring a steel mill or like a shoe company buying a leather tannery. This guarantees them a consistent quality supply, potentially at a lower cost because they're no longer relying on external suppliers and, their price fluctuations.
Makes sense. Control your inputs.
Right. And conversely, it can provide a stable market for their products. That's forward integration.
Okay, so controlling the outputs.
Precisely. For example, a clothing manufacturer buying a chain of retail stores where their clothes are sold. It's all about gaining control over the entire supply chain, top to bottom. Minimize those external dependencies, secure both your inputs and your outputs, ensure consistent quality and delivery. It's about building a really robust, sort of self-sufficient ecosystem.
A classic example that comes to mind, the 1996 merger of Time Warner Inc. with Turner Broadcasting.
Another big one.
Time Warner, already a media giant, got access to all those basic cable channels and historical films, and Turner owned CNN, TBS, TNT, all that. It created this massive entertainment conglomerate, extending Time Warner's reach across both content creation and distribution channels, essentially integrating forward, right? From making the shows to delivering them via cable. But this was not a simple, frictionless deal, was it? What were some of the big concerns there?
No, it certainly wasn't simple. That merger immediately raised some pretty significant red flags from regulators, especially the Federal Trade Commission, the FTC.
The regulators step in.
Yep. Their primary concern was the merger's potential effect on competition in the cable industry. They worried that by combining Time Warner, already dominant, and Turner, with its super popular channels, would just have too much power. Too much power over what content was available, how it was priced for other cable providers, and ultimately for consumers like us.
Right. They could potentially squeeze out competitors.
Exactly. It could potentially stifle competition for other cable providers, limit consumer choice, maybe even put independent content creators at a disadvantage. This scrutiny actually kept the deal in limbo for months. It really underscores that even strategically sound combinations can face immense regulatory hurdles and, public concerns about market concentration and potential monopolies.
It highlights that tension, doesn't it? Between a company wanting efficiency and a regulator trying to protect competition.
Absolutely. It's a constant balancing act.
Yeah.
1.1.3 circular combination.
Now, for one that might seem a bit counterintuitive at first glance, the circular combination. This involves different business units coming together, even if their core products or services seem relatively remote. Like it's not immediately obvious why they'd combine, unlike, say, direct competitors or a clear supply chain link.
Yeah, the connection isn't always as obvious as a direct supply chain. It could be, maybe, that they use similar distribution channels. Perhaps they both rely heavily on online sales platforms or a specific type of retail outlet, or maybe they share a logistics network.
Okay, so shared infrastructure or channels.
Or maybe they share advertising channels, targeting the exact same demographic but with different products. Or even requires similar production processes that could be optimized by sharing specialized equipment or resources. The key benefit here, really, is that having one management group overseeing these combined units can significantly reduce overall administrative and other operational costs. Use centralized functions like HR, IT, accounting.
So it's about the back office savings.
Often, yes. It's about finding those hidden efficiencies and cost savings by leveraging shared, kind of indirect connections, even if their core businesses look quite different on the surface. It's a subtle but potentially powerful play for synergy.
Okay, here's an example that really makes you think outside the box. Pharma Inc., a leading pharmaceutical company, acquires Letts and Watson, a company specializing in building residential real estate for adult communities, 55 and older. At first, you might think, what? What do pharmaceuticals have to do with retirement housing? It seems completely unrelated, almost nonsensical.
Right. On the surface, it absolutely seems unrelated. But if we connect this to the deeper strategic picture, Pharma Inc. might see a really clear demographic synergy.
Demographic synergy. How so?
Well, its target market for pharmaceuticals, especially those focused on age-related conditions, significantly overlaps with Letson Watson's customer base, right? Adults 55 and older. Pharma Inc. could potentially use these communities as like ideal controlled environments for pilot programs for new medications.
Oh, interesting. Like a built-in test market.
Sort of, or even as a direct distribution channel for specialized health services or educational initiatives related to their drugs. And beyond that, the administrative consolidation is a key driver, like we said. They could centralize HR, legal, IT functions, leading to those crucial cost reductions. So the deeper synergy lies in leveraging a captive, highly relevant demographic for both product development and specialized service delivery, while also benefiting from shared overhead.
So it's about leveraging a shared consumer market and support infrastructure, even if the products themselves are totally different.
Exactly. It's not always about the product itself, but the customer or the operational backbone. 1.1.4 diagonal combination.
And finally, the diagonal combination. This happens when a company integrates with another company that provides ancillary or, supporting services for its primary activity. So it's not core to what they produce, but it is absolutely critical support that ensures their core business functions smoothly, like maybe a bakery buying the company that maintains all their specialized ovens.
That's a great analogy. The primary purpose here is really to ensure that crucial ancillary support is delivered in a timely, effective, and reliable manner. It's about bringing a key support function in-house to guarantee its reliability, efficiency, and quality, which is vital to the primary business's mission.
So less reliance on outsiders for critical stuff.
Precisely. For instance, if a manufacturing company relies heavily on specialized software for its operations, acquiring the software developer would be a diagonal combination. It's about optimizing the ecosystem around the core business, controlling those vital arteries that keep the main operation flowing smoothly. And crucially, reducing dependence on external vendors who might not prioritize your needs as much as an internal division would. It eliminates those external points of failure.
Okay, imagine Landbright Farms. They breed organic livestock, sell meat to high-end grocery stores. Their product is highly perishable, needs very specific care during transport.
Right. High stakes for quality control.
Exactly. Now, Fresh Meats, Inc. transports Landbright's products to market in refrigerated trucks. Landbright needs those trucks to be on time every time and perfectly temperature controlled. If Landbright were to merge with Fresh Meats, that's a diagonal combination. It makes perfect sense, doesn't it?
Absolutely.
It completely removes a huge variable, a potential point of failure from their supply chain. Ensures product quality, timely delivery.
It absolutely does. Landbright needs reliable, temperature-controlled transport to get its perishable products to market efficiently and maintain that pristine product quality. Without it, their entire business model could falter, maybe damage their brand. By acquiring Fresh Meats, Landbright ensures that critical logistical support is directly under their control. This eliminates reliance on an outside vendor, reduces potential bottlenecks, guarantees delivery schedules are met, ensures strict quality control for their sensitive products.
Yeah, total control over a critical piece.
And this raises an important question. Where else do we see this type of integration? Think about industries reliant on specific support services. Maybe hospitals acquiring ambulance services to ensure patient transport.
Or construction companies acquiring heavy equipment repair firms to minimize downtime.
Exactly. The principle is the same. Securing vital, non-core support to bolster the core business. 1.2. Transactions, how they happen.
Okay, so we've explored the types of strategic relationships companies form when they combine horizontal, vertical, circular, diagonal. But how do these combinations actually happen in the real world? It's not just a handshake and a promise, right?
Haha, definitely not.
There are specific transaction types, legal and financial mechanisms that make these mergers and acquisitions a reality, each with its own structure, implications, and strategic reasons for being chosen.
Precisely. These are the formal legal and financial mechanisms by which companies formally come together or shift ownership. Understanding these specific transaction types is really key to grasping the full economic effect because each method has different implications. For existing shareholders, for the acquiring company, for the acquired entity.
Right. The how matters as much as the why.
It really does. They determine the structure of the new entity, the financial outlay, the degree of control transferred, even the tax implications. It's about picking the right tool for the job in this corporate chess game. 1.2.1 merger.
Okay, first, the classic merger. This is when two or more separate entities combine to form a single brand new corporation. All the old stocks from the original companies are surrendered, and new stock is issued in the name of this new combined entity. It's a complete transformation, a true coming together to create something entirely new, often with a new name, new identity, symbolizing a fresh start.
Right, and mergers often involve companies of roughly similar size and market standing. That leads to a truly unified identity rather than one company clearly dominating the other. The idea is to create something new and hopefully greater than the sum of its parts, leveraging the strengths of both original entities.
A partnership of equals, ideally.
Ideally, it signifies that fresh start under a new banner, bringing together maybe complementary assets, technologies, or market access that neither could achieve alone, leading to synergistic benefits, enhanced market position. But it's a deeply collaborative move, often requiring tons of due diligence and integration planning, which honestly can be a significant challenge itself. Culture clashes, for instance, are a really common reason for mergers failing to achieve their full potential.
That makes sense. Combining two company cultures must be tough.
Oh,
Okay, a huge example from 2016. Dell Inc. and EMC Corp. merged to become Dell Technologies.
yeah, remember that one. Massive.
Deal valued at close to $60 billion, bringing together two tech powerhouses. Dell had its strong PC and server business, while EMC was a leader in data storage and cloud infrastructure. It wasn't just Dell buying EMC, it felt more like a strategic unification, aiming to offer a broader, more integrated set of solutions to their big enterprise customers.
Right, creating a much more comprehensive technology provider.
It's
Yeah.
exactly capable of competing across a wider spectrum of the evolving tech landscape. The aim was really to offer an end-to-end IT solution from the data center right down to the device. 1.2.2 acquisition. And we have the acquisition. This is a bit different from a merger, mainly because no new company is formed. Only the acquiring company remains and continues its existence. The acquired firm, usually smaller than the acquirer, might keep its legal structure or name, maybe operate as a subsidiary, but it's essentially, subsumed by the acquirer. It loses its independent control.
Exactly. In an acquisition, there's a clear buyer and a seller. It's not like the more peer-to-peer nature you might see in a merger. The acquired firm's identity might fade over time as it integrates into the larger entity, or, like you said, it could operate as a relatively independent subsidiary. Depends on the acquirer's strategic goals.
So the buyer calls the shots.
Pretty much. The acquirer takes ownership and control, often driven by the desire to quickly expand its market share, maybe eliminate a competitor, gain access to new tech or intellectual property, or just diversify its product portfolio. It's generally a faster way to grow and gain competitive advantage compared to trying to build it all organically.
And these can be friendly or hostile.
Yeah, they can be friendly, where the target company's board approves, or hostile, where the acquirer goes directly to the shareholders, bypassing a resistant board. We'll touch on that more with tender offers. And the financial terms can vary: wildly cash deals offering immediate payouts, stock deals giving sellers a stake in the combined future, or often some mix of both.
Okay, here's a fascinating historical example. It shows how the corporate chessboard is constantly shifting. Back in 1984, the U.S. Department of Justice actually instructed AT&T to break up.
The big breakup, yeah. Antitrust.
Right. They had to divest their regional telephone companies because of antitrust concerns. This created the baby bells. But then, fast forward 22 years later, in a really remarkable twist of corporate fate, AT&T reacquired one of those baby bells, Bell South.
Wow. Full circle.
Totally. A massive deal worth over $85 billion. And AT&T retained its name, absorbed Bell South's operations. So sometimes what goes around really does come around into the business world.
It shows how market dynamics and regulatory landscapes just evolve over time. A subsidiary becomes independent, then gets reabsorbed decades later. 1.2.3 tender offer.
Okay, here's where it gets really interesting, potentially dramatic. A tender offer. This is when a company basically bypasses the target company's management and board of directors. They make an offer directly to the shareholders to buy their outstanding shares at a specified price.
Going over management's head.
Exactly. It's like going straight to the source, trying to win over the individual owners of the company rather than negotiating with its leadership. It's often used in what's known as a hostile takeover attempt, when the target's management is resistant.
Right. And the offer can be in cash, which gives shareholders an immediate payout, or it can be in the form of securities from the acquiring corporation, like stocks or warrants.
Warrants. Remind us what those are.
Sure. A warrant is essentially a certificate that gives the holder the right, but not the obligation, to purchase shares of stock at a specified price within a certain time frame. So it's another form of potential value. The key thing with the tender offer is that shareholders have the choice, accept or reject. And if the offer price is attractive, typically it has to be higher than the current market price. Often with a significant premium baked in, it can be a very effective way for an acquirer to gain control without needing the target's board approval initially.
Because money talks,
Yeah,
especially to individual shareholders.
it does. It's a direct appeal to the owners, putting the decision right in their hands. And it can put immense pressure on a resistant board to maybe reconsider or negotiate.
Okay, let's put this into context.
Yeah.
Imagine Biltmore Inc. offers $13 per share to buy Alexander Co. stock directly from its shareholders. If Alexander's stock is currently selling at a lower market price, let's say $11 per share.
Then that $13 offer is an 18% premium.
Exactly. That's incredibly attractive to individual shareholders. They see a clear, immediate profit opportunity just by selling their shares directly to Biltmore. Assuming most shareholders agree to the terms and tender their shares, well, Biltmore gains control of Alexander Co.
Right.
This direct approach just bypasses potential resistance from the existing management, puts the power directly in the hands of the individual investors. It effectively forces a change in ownership from the ground up. 1.2.4 Purchase of assets. Okay, finally for combinations, we have the purchase of assets. This happens when the acquiring company buys only a portion or maybe even all of the selling company's assets rather than the whole corporate entity with all its baggage.
Baggage like liabilities and legal structure, yeah.
Right. This can be a very surgical approach to acquisition. And depending on how much is sold, it could even lead to the selling company being completely dissolved if it sells off all its operational bits and pieces.
Exactly. Unlike buying the whole company, which, as you said, can involve taking on unknown liabilities or tricky corporate culture integrations, this is about acquiring specific things. Tangible assets like buildings, equipment, intellectual property like patents or trademarks, maybe even specific customer lists.
So you pick and choose what you want.
Pretty much. Shareholder approval is still typically required for the selling company, especially if it involves a significant chunk of the company's value because it fundamentally alters the company's future. This strategy might be used if the acquiring company is only interested in specific operational capabilities or physical infrastructure or certain product lines. And crucially, they don't want to take on the entirety of the selling company's existing contracts, maybe its employees, or even its brand reputation if it's not great.
Avoids the unwanted stuff.
Right. It allows for highly targeted growth and gives the buyer much greater control over exactly what is being acquired.
Okay, think about, say, Locks Industries entering an asset purchase agreement with Brightstar Inc. Locks wants to buy about 80% of Brightstar's buildings and equipment. And as part of the deal, Locks agrees to take on the mortgages and capital leases specifically associated with those assets, but not other Brightstar debts or obligations.
Very targeted.
Exactly. It's a very targeted acquisition of physical resources. Brightstar, in this scenario, might keep its corporate shell and maybe some other operations, or it might just decide to liquidate completely after selling off its core operational components.
And this is ideal when a company wants to, say, expand its production capacity or gain specific tools without inheriting an entire organization and all its complexities.
Divestiture, moving apart.
Okay, so we've seen how companies strategically come together, right? Driven by motivations of growth, efficiency, market expansion. But businesses are constantly evolving, and sometimes, for various strategic reasons, they actually need to separate or shed parts of their operations.
The flip side of the coin.
Exactly. This brings us to the equally fascinating world of divestitures, essentially, the opposite of combinations, where pieces of a company are strategically taken apart. And it's not always a sign of weakness, is it? Often it's a deliberate move to maybe unlock value or sharpen focus.
Absolutely. A divestiture involves the partial or full disposal of a component or a business unit of a company. It's a deeply strategic decision, maybe to streamline operations, maybe unlock value that might be hidden within a larger conglomerate, or sometimes, out of necessity, financial distress, regulatory mandates forcing them to sell something off, or simply a desire to return capital to shareholders.
So lots of different reasons.
Many reasons. And just like combinations, there are distinct types of divestiture transactions. Each has its own purpose, its own method for separating assets or divisions, and different implications for the parent company, the divested unit, and the market. They really reflect a company's evolving focus and market strategy, kind of like reshaping your chess pieces for a different phase of the game. 2.1 sell-off.
Okay, first up is the sell-off. This one sounds pretty straightforward. It's just an outright sale of a subsidiary or a specific business unit or maybe a segment of a company to another entity.
Yeah, it's the most direct way to divest.
Like selling off a non-core asset just to streamline operations, maybe raise some cash, or simply get rid of a division that isn't performing well or doesn't fit the overall strategy anymore.
Exactly. Companies often pursue sell-offs if a subsidiary's core competencies just don't align with the overall company's long-term strategy anymore. Or if there's a lack of synergy, meaning the subsidiary doesn't really fit well with the parent's other operations, or maybe it's even creating a drag on overall performance.
A drain on resources.
Could be. And sometimes legal action, like from anti-competitive or antitrust practices, can actually require a sell-off, forcing a company to shed a division to maintain fair market competition. We saw that with AT&T's breakup decades ago.
Right, forced divestiture.
So it's about shedding what no longer fits or what regulators mandate to allow the parent company to focus on its most profitable and strategic areas and potentially improve its overall valuation by presenting a clearer, more focused business to investors.
And it can be a quick way to raise cash, too, I guess.
Oh, definitely. A
Yeah.
very direct way to generate capital.
Okay, consider Becco Industries. They own Blended Ltd. Management and shareholders might start to believe Blended Ltd is causing the overall company, Becco, to be undervalued in the market.
The conglomerate discount idea.
Right. Perhaps investors just don't understand the diverse businesses within Becco, or maybe Blended is simply underperforming, making Becco's stock price look less attractive than its parts might be worth separately. So, to simplify their structure and focus on their core business, they just sell Blended's assets and liabilities to another company. The hope is that investors will react favorably to this now simpler, more focused Becco and boost its stock price by valuing the remaining, more synergistic operations more highly.
It's a strategic move. Focus, simplify, potentially increase market value by removing what's perceived as a drag or just a distraction. 2.2 spin-off.
Next, we have the spin-off. This is where a new independent company is created by separating a subsidiary business from its parent. It's kind of like a parent company sending its child off to start its own life, but with a twist, right? The parent's existing shareholders often receive shares in the new company.
That's the key difference from a sell-off.
So they still own a piece of both entities, the parent and the newly independent child.
Exactly. A spin-off can be completed in a couple of ways. Either by distributing stock in the new entity as a stock dividend to the parent company's existing shareholders, or by offering shareholders stock in the new company in exchange for some of their stock in the parent. The key is that the ownership structure remains broadly similar for the original shareholders, but the businesses become legally and operationally separate entities.
Why do this instead of just selling it?
Well, spin-offs typically occur when a unit is maybe less profitable or its operations are just unrelated to the parent's core business. The thinking is it would thrive better independently, free from the parent's strategic direction or maybe its resource allocation constraints. The assumption is that this spun-off unit will actually have more value operating independently than it did as part of the larger entity.
Freedom to pursue its own path.
Right. Free to pursue its own strategy, access capital markets independently, respond to its unique market dynamics without the constraints of the parent. It also allows for clearer investor understanding and valuation of each distinct business. Investors can choose which story they want to invest in.
Okay, a great example is Eli Lilly and Company, the big pharmaceutical giant.
Right.
Back in 1994, Lilly decided it wanted to focus purely on pharmaceuticals and its core drug-related businesses.
Sharpening their focus.
Exactly. So they strategically spun off their medical devices division. That division then went public later that same year under the name Guidant.
Guidant, yeah, I remember them.
Guidant then focused entirely on cardiovascular medical products, pacemakers, stents, defibrillators, totally distinct from Lilly's drug focus.
It was a clean break.
Totally. It gave both entities a clearer path and allowed Guidant to focus entirely on its specialized market without its value being sort of diluted or overshadowed by the larger pharmaceutical business within Lilly. It showed a real strategic decision to simplify and focus. 2.3 equity carve-out. Okay, finally, the equity carve-out. Now, this sounds similar to a spinoff, but you said there's a crucial difference that makes it unique.
Yes, a very important difference, especially financially.
The subsidiary is made public through an initial public offering, an IPO. For those maybe unfamiliar, an IPO is when a private company sells its shares to the public for the first time on a stock exchange. So with an equity carve-out, it's like launching a new company onto the stock market, but the original parent company keeps a significant piece of the pie.
Exactly. It's a way to introduce a subsidiary to the public market while the parent still retains a strategic interest and, crucially, gets cash.
Ah,
Yeah.
cash. That's the difference from a spin-off.
That's the key difference. Unlike a spin-off, where typically no cash comes directly back to the parent company, the sale of shares in the new company during the IPO generates immediate cash for the parent. This could be a significant financial benefit, provides capital for maybe other investments, paying down debt, or even shareholder distributions like dividends or buybacks.
And the parent keeps control.
Critically, yes. The parent company also typically retains a controlling interest in the subsidiary, often owning more than 50% of the shares after the IPO. The hope is to unlock the independent value of the subsidiary, value that was maybe hidden or undervalued within the larger merged entity. The market can now value it separately based on its own merits.
So you get the best of both worlds. Cash now and potential upside later.
Kind of. You get the cash infusion, you allow the market to value the unit separately, and the parent retains strategic influence and can still benefit from the subsidiary's future growth through its remaining stake. It's a pretty clever way to raise capital and gain a separate valuation without fully divesting control.
Okay, let's look at Teco Industries, a fictional multinational with several diverse divisions. Management fears Teco isn't focusing enough on its core business and wants to divest a unit that doesn't quite fit their long-term vision.
Okay.
However, they want both things: a substantial cash infusion from the divestiture, and they want to maintain some control over the divested unit's future. Maybe for ongoing supply chain reasons or strategic partnerships that might still exist between them.
So a straight sell-off or spin-off doesn't quite fit the bill.
Right. The equity carve-out is the perfect choice for them. It provides that much-needed cash from the IPO of the subsidiary, and it allows Teco's management to retain a controlling interest in the new publicly traded entity.
It gives them strategic flexibility and significant financial benefit, a balance between divestment and ongoing influence. It's a very smart tool in the corporate finance toolkit. Outro. You know, what's truly fascinating here, when you step back, is how these significant transactions, whether they're combining companies or divesting parts of them, are so much more than just complex financial maneuvers happening behind closed corporate doors.
Yeah, they have real-world consequences.
They fundamentally reshape entire industries. They redefine global supply chains. They even impact the variety, the pricing, the innovation of the products and services that, we interact with every single day. They reflect these deep strategic choices about efficiency, market reach, competitive positioning, and really a company's core focus in this ever-evolving global economy.
Yeah.
Understanding these dynamics is pretty key to being well-informed about the world of business.
Absolutely. So next time you hear about a big merger or a company's splitting off a division, maybe spinning something out, you'll know there's a whole world of strategic thinking, economic impact, and complex financial engineering behind it. You'll hopefully understand the why behind these massive business moves, those deliberate chess moves on the corporate board we talked about. And this raises, I think, an important final question for you, the listener, to consider. How do these constant shifts in corporate structure, the consolidation, the breakups, ultimately affect innovation and competition in the long run?
That's the big question.
Yeah. Does consolidation stifle new ideas by reducing the number of competitors? Or does it actually create more efficient behemoths that are capable of groundbreaking research and development, stuff that smaller players simply cannot afford?
A real trade-off to consider.
Definitely something to ponder as you look at the world around you and the products you use every day.